Hi there, welcome to the closing bell on the 12th of Feb. We've had the CPI figures during the week in the US and they certainly came out pretty bad, even though quite a few people in the market thought they'd come out all right. So inflation really is taking off. Those bonds really are selling off now pretty hard. The stock market is trying to hold in there, but had a bad night Thursday night, and you'll know more than me what happened last night. But things are teetering, and I will show you the setup in those charts in a minute. But before I get going, look, right at the moment, I am welcoming new people into my service, Pivot Trader. And we do have a presentation for you to check out, just to learn a bit more about my strategy. If you've been enjoying these videos and you've been watching for a while and seen the fact that I've picked the correction that happened, I've told you what would happen in those bonds and how they would accelerate to the upside once they went through 1.9% in those 10 years. There's quite a few things lately that I've been saying that are coming to fruition now. So hopefully you've built up a bit of a picture in your head about my work. And if you want to know a bit more, just click on that. There's a little little information button in the top right corner of your screen. Just click on that and click on the picture of me, and you should go through to the video to check it out. And in that, you'll go into a lot more detail of my strategy, how I make money for people, how I manage risk. And look, I trade stocks. So I trade mid cap, small cap, all sorts of stocks across the spectrum. I've had a 60% strike rate over, nearly 2.5 years. I make 3 times as much on the winners and we lose on the losers. So the actual performance has been really good. And I'd love for you to check it out and hopefully become a member of Pivot Trader, because it's been about a year since I've taken on members, and that is happening until next Monday. So do please check it out. Now, just moving on to the markets now, let's have a look at those US 10-year bonds to kick off with, because it really is the crux of the matter for the markets right now. So I have been showing you this chart. This is going back a decade. And the main thing to point out, I was saying above 1.9%, you had to watch out because, or that was 1.8%. So, around that region, I said, watch out, this thing could spike towards 2.2% to start with and possibly even higher. So now that the sell-off has started, we don't know where it's going to stop. It's not necessarily just going to go up a little bit and stop. It could get a bit out of control, which could really make equities sell off hard. So my reasoning on this one, I was just looking at this range from a decade ago, and we're looking at prices moving back to the midpoint of that range, around 2.2%. And so we're really starting to do that now, but things could overshoot up into the sell zone of the area. So, I could see rates up around 2.6 to 2.8% in this wave higher. And look, the last time that US 10 years were at 3%, stocks were 40% lower. And stocks really have been rallying on the basis of falling interest rates because you're looking, you're getting a net present value of all those future cash flows. And you've got very low interest rates. All of a sudden the value of those cash flows is going up and up and up. But now with rates turning around, I think the heat can come out of the market. So you do have to be wary as these rates shoot higher. And looking at the 2 years, you can see that it's really starting to go a bit nuts, quite frankly. This is the 2-year bonds going back a long way, back to 2000. And you can see the last time in 2012, 2-year rates were very slow in the way that they started to move higher as the Fed was raising rates. Now, this time, the market has been caught off guard, right? With the yield shooting from nearly 0 up to around 1.6%. I mean, it is accelerating. That inflation taking off, people now thinking they may even do a bit of an emergency rate hike before the next meeting in March. I don't know that will happen, but they need to stop printing money and they need to raise rates quickly. And it's going to be interesting to see just how much the equity market can take. And I showed you the high yield bonds last time, and that's the HYG, which is the sort of the high yield bonds in corporates in the US. And I showed you that last week, saying, you know, it was starting to look pretty dangerous, and it's actually accelerated to the downside this week, which is getting me pretty nervous. You can see that from the 2020 crash, how terrible the sell-off was. But things have recovered in a big way and really just come up to test that downtrend from the last decade, and has really tipped over now and is accelerating to the downside. So who knows where it stops. But if those corporate bonds are really selling off hard, I think the equities are going to start to feel a bit of heat as well. So really things are set up right now. They're pretty primed. I just want to move on to the S&P 500 weekly chart again, just to recap what's been going on, because last week I did say, you know, we've got the long-term, also the weekly trend with that 10-week exponential above the 20-week simple. It's been like that for 20 months. This is the first time we've had that weekly trend turn down. And so often what happens, you have the initial wave, it'll go back to retest the moving averages, which we've seen. And then we've had the bad inflation figures. And then if things turn down from there, it can get really ugly if that low gets breached. So it's just a setup that you don't see very often. And when you do see it, it can turn into some pretty big moves. You know, if I just quickly go back over, you know, a lot of data, you know, there is only really a few instances over that time where we've had things really turn down on that weekly chart. And in every one of those instances, you've had the situation I'm talking about, where prices have gone back to retest the moving averages before turning down and getting absolutely hammered in that next leg down. So this is a situation we're in. Doesn't mean this time it's definitely going to sell off. It just means that the technical situation is saying if the selling's around and we do see that market turning back down, and with the situation as it is with those terrible inflation figures, it is sort of a moment when that could happen, that it could, get pretty ugly. So, you know, maybe it takes time. Maybe it's going to have a bit of a sell-off and then find the buying support again, and we go into another few months of grind. But the situation just is one where you've just got to tread a bit carefully. And I have been warning about that for quite a while. I've certainly taken lots of profits and I'm waiting for, you know, a bit more selling to happen so that I can start looking for opportunities for people. But, you know, there are opportunities out there. There's no doubt about that. All prices are taking off. I think gold is on the edge of taking off again. I did actually give you a free trade in that video, which you can get to by pressing that button in the top right. Press that little I button, go through there. You can watch the vid, and you do get a free trade, which you can check out. My most recent trade I sent out to members. So there are opportunities out there. It's great for traders when the markets are really wild like this. So I'm actually enjoying it after it's been such a dull old time for months. So look, plenty of opportunities to come over the next few months, especially if we do see markets really keel over and get smashed. I mean, that's when you want to be ready and waiting, ready to pounce. So yeah, I've been setting you up in this for quite a while. I've shown you my, you know, how I go about things, and hopefully by now you understand that I've been picking quite a few things right in all of this market for the last few months. So hopefully you want to go and check out what I'm doing. So anyway, that's it for this week. I shall come back with more next week, and I promise not to be marketing my service too much to you next time. All right, cheers. I'll chat to you then.